welcome to Hello everyone, and welcome to Known Co-working and SCORE Fairfield County's workshop on Planning and Managing Business Growth, Financial Plan. I'm Peter Talion, the workshop coordinator and a business mentor here at SCORE Fairfield County, and I'll be your host. Our speaker today is Frederick Welk. More on our speaker in just a moment. This virtual and in-person workshop is being done in collaboration with Known Co-working, which is providing its facility for the in-person part of the workshop. Barb Nagel from Known is the host, who is in New Haven. First,
Hi,
some brief
everybody.
information. Go ahead, Barb.
Hi, sorry about that. I thought you were introducing me at that time. Hi, everybody. My name is Barb Nagel. I am the community manager here at Known. We are a co-working space and an entrepreneur serving organization in downtown New Haven. In addition to having co-working space, which means we offer flex desks, dedicated desks, and private offices, we also host a number of networking events each month specifically geared towards entrepreneurs. We do training and mentoring in key business areas. We also offer a next level business coaching program, and you can get a free 20-minute business discovery session if that's something that you're interested in. I will be dropping a link to that in the chat in a few moments. If you live in the New Haven area, we would love to have you come in. You have access Monday through Friday, 9 to 5. For day passes, and those people who become members at the flex desk, dedicated desk, and private office membership levels have 24/7 access to the space. Thank you so much. We're really excited about having this series with SCORE, and I'm also really excited to hear from Fred today at CEDF because we have a partnership with CEDF whereby people that enter our BIPOC Business Accelerator Program, which we call the Knownpreneurs Program, or the Knownpreneurs Growth Lab, when they graduate from that program, they qualify for a $10,000 line of credit through CEDF. So it's really exciting to be working with both SCORE and CEDF on this workshop today. So thank you so much to SCORE and to Fred and the folks at CEDF. Welcome.
Thank you very much, Barb. We'll get to Fred's presentation in just a moment. First, some brief information on SCORE. SCORE is a nationwide organization with 230 offices and over 10,000 volunteers. We're part of the Small Business Administration. In SCORE Fairfield County, we have over 100 volunteers with a wide range of industry, process, and subject matter expertise. We offer 3 primary value-added services to small business owners. Free one-on-one counseling. This can be done face-to-face via the telephone, email, or video, which can be accessed via the Request Mentor link on our website or via the link on the screen. We also offer educational workshops and webinars, about 100 per year. Today is an example of one of those workshops. And we have very extensive resources on our website, including a network of subject matter experts at your disposal. Some useful information about today's events. If you have a question, please use the chat window at any time during the presentation. You can also use the Q&A button on your screen. Our workshop will end at 1 p.m. to respect your time. The session is being recorded, and the link to the recording will be available at fairfieldcounty.score.org within the next couple of days. Now it's my pleasure to provide a background for our speaker today. Frederick Welk is a CEDF business advisor and serves as Director of Business Education and Communication. Before joining the organization in 2013, he spent more than 30 years in specialty retailing and franchise development, operating his own company for 23 years. As an adjunct lecturer at Gateway and Housatonic Community College, he has taught a variety of entrepreneurship courses. With that, I'll turn it over to Fred. It's all yours.
Well, thank you very much, Peter. We appreciate the collaboration with SCORE Fairfield County, and Barb, thanks very much for the collaboration with Known as well. We happy to work with any of the ecosystem partners throughout the state of Connecticut, where the Community Economic Development Fund is mission driven to help those businesses that can't get bank financing quite yet. We'll help you get on your way and hopefully graduate toward better days ahead financially. So that's, I guess, kind of the theme of today's presentation. We appreciate the invitation from SCORE to present here in the third part of your series on planning and managing business growth, the financial plan. So let's talk about what we're going to discuss today. We'll go through the agenda here. Let's use this button here. So I was asked to discuss kind of the way to estimate incremental financial needs for your business when it's growing significantly. And yeah, a business has a lot of different needs, especially when things are moving fast. So we'll get into some of those ideas. We'll also uncover some methodologies for tracking financial performance based on forecast assumptions and contingencies, which sounds like a mouthful, but the important word there is methodologies. We're going to do it methodically. And we're going to mention some options for funding growth, although probably other webinars are going to cover that in much more detail. And then we will talk about the resources available to provide guidance throughout these processes, because they're kind of complicated. So let's dig right in to estimating the incremental financial needs of a business that's growing. Well, the first thing that you need to have is financial statements. And I know that sounds like a very simplistic thing that, well, sure, everyone has financial statements for the business, but maybe not. The small businesses that we often encounter, even if they're in a mode of substantial growth, sometimes really don't have a handle on how to keep score of the ball game. And so the basic tools that you need are certainly including a balance sheet. And sadly, a lot of entrepreneurs, small business owners are a little skittish about a balance sheet. They find it maybe complex. Maybe they don't really understand the use of it. They perhaps have a disincentive if their QuickBooks isn't well cleaned up nicely, and things on the balance sheet don't seem to make a lot of sense. So we do understand why folks shy away from it, but unfortunately it's a key tool. And if you're approaching a lender, a balance sheet's really kind of the first thing that a lender wants to look at, because the balance sheet really unveils the financial health of the business. And again, we won't get into all the particulars about what's on it or what you're looking for. That's better dealt with in some other webinars, like the ones we have on our weteachsuccess.org website. But balance sheet's the important place to start. The other thing that you got to round up is an income statement. And folks are a little more disposed to use income statements. In fact, I would say to a fault. A lot of small business owners only want to manage off of their income statement for some reason, even though QuickBooks is really swell at providing the other financial reports at the push of a button. The difficulty comes into the fact that when you're planning growth, you may need to consider some, how would I say, unusual characteristics of an income statement. For one thing, depending on the kind of business that you have and the way you are tracking your cost of goods sold, you may have, in effect, what I would call roller coaster income statement or profit and loss results. If you'll imagine, for instance, a food business, a restaurant, and if the restaurant doesn't keep really good track of their cost of goods sold, and if they don't post to the bookkeeping on a regular basis in a methodical way, and if they choose not to take a periodic inventory of, let's say, the food in the pantry, what you're going to end up with is, again, a roller coaster income statement where you book a bunch of things one month because you placed a bunch of orders, but then things really get consumed in other months. And it's really kind of hard to tell whether you're profitable on a month-to-month basis. So that is a consideration in a number of other industries also. So this points to a need perhaps to consult with your CPA to get some plans in place for better bookkeeping, so you don't have unreliable judgments made based on unreliable financial reports. The other thing is the depreciation, of course, tends to get only posted at the end of a fiscal year. Sometimes small business owners don't even go back to their CPA to get the adjusting entries to keep up with the depreciation, or if those reports are maybe provided by a CPA and depreciation is on the income statement for a prior year, but you're not working with current income statements out of QuickBooks, sometimes a non-cash expense like depreciation is going to, well, you're going to run the risk of not understanding your true profitability as you grow the business. That's probably as much as we can say today in the time allowed. The other thing that you want to perhaps continue to look at, or maybe start to look at, would be what's called a statement of cash flows. This is also referred to as a statement of changes in financial position in the accounting profession. And this is really great for answering the question, oftentimes at the end of the year, when you're sitting in the CPA's office in tears, wondering, well, if you say I'm profitable, how come I don't have any money in the bank? So statement of cash flows helps you track kind of what the money gets spent on. And small businesses often kind of get into difficulty when they're spending money on assets because that hits the balance sheet, but not the income statement. And it makes it difficult for planning purposes if they're not keeping good track, mentally at least, of where the money comes from and where it's going. The other thing I want to distinguish here is the difference between a statement of cash flows, which is a financial report that you crank out of QuickBooks, and a cash flow forecast, which is a spreadsheet that a business owner who owns a growing business ought to be keeping. And the cash flow forecast, most often encountered if you're going to a bank to get a loan, they're going to want to see cash flow forecasts for the future periods to kind of demonstrate that you're not going to run out of money in the middle of the project. So we happen to have a course on our website at weteachsuccess.org that'll show you what a cash flow forecast is all about. And if you're not familiar with those, and if you're not keeping up with maybe a rolling cash flow forecast going forward, if you're in a high growth mode, maybe that's a technique that you want to use. All right, so the next element of this particular discussion is identification of the growth drivers that are going to kind of stoke the added altitude in the business. And that logically is increasing sales, but I want to point out that it might come from some other sources. For instance, you might end up divesting some equipment and selling it off. You might end up bringing cash into the organization in a different way, or bringing sales into the organization in a different way, let's say. You may end up acquiring another entity that will stoke the sales or the revenue, that is, and you might end up perhaps just doing some general restructuring of the business. So increasing sales is a little bit bigger topic, but let's talk about how most people think about it. Well, they usually think about, well, let's just go out and get some more customers. And, you know, that's possibly a good approach. But you may want to ask yourself, who are your best customers? And maybe we should get more of the better customers as opposed to just getting more customers, because more customers in general might come with a lot of, how would we say, expense tied into the servicing of those customers, whereas getting more good customers might be more economically efficient. Should also contrast against expanding into new markets. which I'm kind of using in this sense of expanding into new geographies. Maybe you would have a service area for the business that you're not currently involved in. Maybe it's a different mode of selling. Maybe you have a brick and mortar location and you want us to do more e-commerce or vice versa. So new markets is a certain possibility, and it all, hopefully it will lead to more sales and lead to it faster than more expenses. The other thing, which maybe is the most obvious, and people will think of this, is adding new products or services. Well, that's a possibility, but I'll tell you just from my own experience that, simply tacking on a new category to an existing business is a little more complex sometimes from the viewpoint of the customer. Customers kind of know you for what you've been providing them over the years. And simply adding a new category of something doesn't necessarily draw the same customer loyalty automatically. When I was involved in specialty retailing and shopping malls, and in a particular memorable time, which was very difficult economically, I remember being out searching for new categories of business to add to our offerings. And, I guess what I found was, to use an example, that simply putting candles on the shelf wasn't necessarily going to have everyone running into my store to buy candles. Certainly when they could go to the store down the hall in the mall, which sold only candles, that's the logical place customers were going to go. Me having a smattering of another category isn't necessarily going to draw interest from customers. Another thing that we need to do to estimate our needs is to forecast sales and revenue. And the method for doing that certainly involves historical lookbacks. And again, going back to the financial reporting, you have to ask yourself, well, is your historical data of your financial results, is it accurate? Are you going to be making judgments based on solid information? And if you don't have the bookkeeping in place, that's going to give you confidence in that, you may have to go back and do some cleanup in past years. The other thing that you want to look at probably is trends in the marketplace. And, that's a very general observation. And I think in this day and age, when we're having all sorts of, what would we call it, meta shifts in our economy, it's kind of obvious that this is going to have a big impact on going forward. So it's going to be pretty specific, and the business owner is going to be the one to make the judgments about that, I would suspect, as opposed to being able to bring in outside experts to make judgments for you. One expert category that you shouldn't overlook, though, is the insights from your sales team. Because if you have other individuals involved in sales in your organization, although many small businesses rely on the owner to do the bulk of the selling, heavy lifting, but again, if you've got folks on a sales floor in a retail environment, or if they're selling in an industrial environment, out talking to customers, maybe the boss needs to consult with them, because if they're kind of closer to the customer, their ear is to the ground and they're going to come back with better information, perhaps more frequently. One thing that needs to be included in forecasts is what we call alternative scenarios. And this is very simple to explain. It's a worst, best, and most likely scenario that you probably want to apply to the financial forecasts and the other planning that you do. Finally, we want to look at fluctuations. And fluctuations could occur with maybe the timing of sales because of seasonality. Maybe it's the timing of receipt of payments. All of these things will affect a financial forecast, and they're going to be very particular and specific to an individual business, but they got to be kept in mind, and you want to keep them on your list and be sure that you've accounted for it. So moving into the next area is the assessment of operational costs. Well, you got to ask yourself, if we're going to add more sales, is this just going to be money that falls into the lap of the business owner, kind of like the results of a slot machine at Las Vegas. Well, no, we probably are going to have a number of expenses related to producing that additional revenue or delivering it, whether figuratively or literally, depending on what sort of business you're involved in. And, want to take a hard look at what it's going to cost to make more, especially because the efficiencies getting going on a venture is not necessarily going to fall into place right away. Probably it's going to take some expense of marketing and advertising to get out the word, especially if looking back to some of the prior elements, if we're going to expand our geographies or expand our product categories. And usually with more production of revenue brings more staff, and the headcounts are certainly a part of it. But wage inflation in our current environment is something to be considered. And the other factor is the training time, that folks are not necessarily efficient right away. And if we're doing a planning scenario for a year or 2 or 3 down the road with some substantial growth being considered, well, how long will it take an individual to become productive? It may vary enormously. Some simple retail environments, you might have someone who's productive after a few days or a week. Other business lines, it literally could take months or even years. The other thing to be considered is the need for more infrastructure. And here I mean facilities. Are we going to need more space in order to run our shop in a commercial or industrial environment, for instance? What is it going to take to be able to produce more stuff? Factory is very obvious. You might be able to squeeze another machine onto the factory floor, but depending on the scale of the growth that you're planning, maybe there's going to have to be another building someday, a bigger building or more buildings. So got to be on the list. The other thing is whatever technology is going to be needed to support that new environment. And sometimes it's very clear to the owner of a business that, well, we're kind of scraping by right now, doing things, paper and pencil and doing things the hard way. And, there is that real cool software widget for our industry that allows you to just kind of feed everything in and keep good track of it. And sure would love to have that. And, we probably should have that in order to justify our planned expansion. But, well, what's it going to cost? And what's the time frame to get the whole thing active and actually productive within the environment? Next consideration here is taking a close analysis of the working capital and cash flow needs. And by that, I'm talking about the fact that, well, if we sell physical stuff, maybe we need more inventory. Well, that's going to perhaps improve the change in inventory turnover if we're more efficient and more profitable. But you know what? It's been my experience over the years that you put a bigger pile of anything into the business and you actually have a tendency to decrease efficiency before things turn the other direction and you get more efficient. So you got to be aware about that simply having more stuff on the shelf doesn't necessarily mean that you're going to have better turns. Sometimes lean and mean is best, and growth doesn't necessarily lend itself to lean and mean unless it's managed very carefully. On the accounts receivable side, we also have to be conscious of how long it takes to get our money. And simply because we have more customers doesn't mean that they will all start paying as fast as our customers currently are paying us. Hopefully that's a good number, not a bad number. But again, my kind of law of the universe is that if you have more of something, you don't necessarily get efficient just because it gets bigger. In fact, it probably gets less efficient first unless it's managed very carefully. The obvious thing is that day-to-day operational expenses will probably go up as you plunge into more growth, and that has to be, perhaps very carefully assessed. You got to be maybe miserly in order to reach your profitability plan. And there's always that tension between, kind of what we need to make our revenue target versus what we need to make our profitability targets. So that's, again, very particular to a business. On the payment side, maybe we need to take a good hard look at what sort of terms we're getting. If we're going to have more revenue, higher sales, that probably means we're buying more stuff from our suppliers. And if we're buying in greater volumes, maybe we deserve a little better treatment from those suppliers. So, a hard look at whether we can negotiate some good terms or better terms, this may be the time to do it. So a lot of industries, of course, they work on a cash basis. That is, kind of buying things COD. And maybe that transition to getting terms in their particular industry is not an easy one. But in other lines of business, it's certainly more customary, but anything you can do to stretch out your payables while you maintain a good relationship with your suppliers is probably pretty important. And then the timing of cash inflows and outflows needs to be carefully maintained. And this is back to why we want to have cash flow forecast spreadsheets to be able to take a close look at kind of, the prediction of what's going on, what's going to happen in the coming periods ahead. So, significant growth for businesses that rely on the business owner to wear a lot of hats gets to be particularly challenging because, maybe you don't really have that great bookkeeper. Maybe you don't have any in-house financial folks. You're too small to have a controller. Maybe the office manager has been involved in some of these things, but maybe doesn't have the background or the talents to do it. And then there's always a hesitancy, unfortunately, with small business owners to go out to professional accounting firms, their CPA, who they unhappily meet once a year, about 10 minutes to 5 o'clock on the 14th of April, when they drop off their grocery bag full of receipts to have their taxes done. If that relationship with a CPA is not established already, you don't have anyone to turn to maybe get an ad hoc project of forecast and spreadsheets jump started. That's going to be tough. So employing all these tools really requires planning in itself to make sure that there is the money available for this capacity expansion that the business needs to be able to start behaving like a real bigger business. And then finally, in this section, we want to talk about, well, how do you prepare a financial plan? Well, it's very easy. You're going to do projected income statements and projected balance sheets and projected cash flow statements. And we're going to do our cash flow forecast that we've discussed. And then we also need to start calculating some key financial ratios, which, again, a lot of small business owners may have heard of, but they don't do it on a regular basis. And I would say that, if you want to be in a growth mode for your business, but you don't have ready access to the financial reporting, if you don't know what the score of the ball game is until the bookkeeper kind of drags in some of your financial statements, maybe 45 days after the end of a particular month, you don't have the resources you need to really do a good job at this growth effort that you're undertaking. You want to try to start to live in a more immediate world, and the The financial software products will let you do that if, in fact, you can build the relationships with the providers to be able to turn the crank on the black box so you can get the information out on a much more timely basis. Finally, what do? Well, we got to tweak everything as we go. We want to compare our performance against our projections to be able to know what we're doing well or not. And then, as the business continues to grow, we make our adjustments accordingly. And, we keep looking back at the financial plan to see if it continues to make sense. And, there will be things in the business environment or our global strategy that may change based on kind of local events or industry events or changes in the economy or competition that enters the market. These plans aren't going to be static. They need to be adaptable. So that's kind of how it's done. But let's do a quick recap here. These are the elements that we say that we need in order to be able to do the incremental needs assessment. So be glad to make the slides available to any of the participants later on if you want to use these as a checklist for what you've got to consider to put yourself in the right position for growing. So let's move on to another element here, which is the methodologies for tracking our financial performance. So the first thing is a term I really love, variance analysis, because it sounds so complicated. But actually, what are we doing? We're just comparing our actual to our forecasted numbers. And then, well, we want to identify what's different, and then ask ourselves, well, why is it different? And then, the variations in revenue and cost and profitability, they all need to be tracked. So variance analysis is a methodology for figuring out what's going on. And it sounds very complicated. It'll make us feel very good, very smart, but it's as simple as looking at the difference between what we said is going to happen and what's really happening, and then putting our finger on the whys. The next thing that we'll use as a methodology for assessing our performance is KPIs, that is key performance indicators. And these can be very different in each industry by nature of the fact of what's kind of important in that industry. But an example would be the revenue growth rate. If you say that you want to grow from A to Z, well, that probably assumes a certain rate of growth from a certain period, let's say year 1, year 2, year 3. So maybe we want to take a look at, well, how quickly are we achieving our results? So we look at our rate of growth of revenue, and in the stock market, this is done all the time. This is a very common sort of benchmark to put on a company's efficiency. The other thing that you want to keep your eye on is that gross profit margin. And it's very easy to let that slip as all sorts of efforts and things are being thrown up on the wall to see what sticks sales-wise. But sometimes we don't keep in mind, well, we've got to maintain some efficiencies with how we buy in order to have that drift to the bottom line. But gross profit margin is a key performance indicator, certainly so in the retail industry. And sadly, sometimes small business owners really don't focus on how to calculate that properly. The operating expenses as a percentage of revenue is another very handy tool. And if you run any kind of financial report, just dividing things into the revenue or the category on a balance sheet is a very useful tool to unlock kind of, the relative importance of that particular line item. The other thing that I would recommend you look at is customer acquisition cost. So remember we said we don't necessarily just want to get more customers. We might want to perhaps get better customers. So knowing what it costs to acquire a customer, folding in all those marketing expenses and so forth. Well, we can talk about this more when we answer questions at the end of the discussion here. But customer acquisition cost is something that's often overlooked, let me say. The lifetime value of a customer is also something that I find that a lot of small business owners don't really focus on. You know, it's one thing, you know, how good someone is as a customer. We think about how much they bought from us this year, let's say, but, you know, kind of looking at the bigger picture, how long does someone stick with us in our industry? You know, if I can keep someone for X number of years, you know, maybe I can justify a little bit greater acquisition cost if I know I'm going to get that money back over time. So a KPI like that in planning growth is pretty significant. The return on investment, very common KPI that you find from looking at the balance sheet and the equity section generally. But again, we're going to make spend a bunch of money kind of creating the machinery for all this growth that we intend. Well, we want to be sure that we're actually getting our return. And then finally, we want to look at the benchmarks or goals that are significant for our industry. And maybe we want to look at some other similar businesses to see kind of how they're doing in comparison. So benchmarking can be a very useful way to uncover some KPIs that are useful for your enterprise. Then we're going to get into budget monitoring, which simply means that, well, someone's got to have their hand on the switch of the engine. Because, well, if you're not looking at what you intended to spend against what's on the budget, you're not going to have a result of cost control, and your cash flow is going to get out of whack also. So here again, it's easy to spend money like a sailor if you're in a growth mode. Sometimes businesses bring in extra capital from one source or another, and it's easy to put that into action, but it's not so easy to watch against the budget for how we're doing against our plan. Then, of course, cash flow analysis needs to take place, and that's simply tracking the cash in and the cash out. And I'll say it again, a cash flow forecast spreadsheet is a very handy tool for kind of knowing whether we're on plan here. So we want to compare our actual to forecasted cash flow. And if we're successful, we're going to better meet our financial obligations. We're not going to be late on paying our vendors, for instance. We're going to be able to manage our working capital smartly. We won't borrow too much money off of our line of credit because we won't need it. And we won't have money parked in the checking account and paying interest unnecessarily. And then we'll also be able to spot the issues of cash flow, perhaps as it relates to maybe collections in accounts receivable and so forth. So we kind of touched on the idea of scenario analysis and looking at different scenarios based on the assumptions and contingencies, which again sounds very erudite and complex. But it's simply best case, worst case, most likely scenarios, and what is the impact going to be on our financial performance, and what are the associated risks and opportunities that are related to that scenario analysis. We got to be honest with ourselves here in these forecasts. It's nice to have rosy pictures. It's maybe tempting to make rosy scenarios in order to show off to investors or lenders, but we want to, how would they say, hope for the best and prepare for the worst economically. Finally, rolling forecast is another tool, and this is particularly useful because it can replace the habit of using static annual budgets And by the time, you get to the 10th or 11th month in a static budget, maybe conditions have changed so much that that budget doesn't seem like it's as relevant. So on the other hand, if we just continually update our projections and we consider kind of what's going on in our world, then we're going to be more adaptable. And we'll have the ability to keep a better eye on our financial performance. And, we'll probably have more accurate results in our future forecasts and projections because we're keeping our eye on current information. Finally, we have the tool called the break-even analysis, which, simply defined is the point at which your revenue equals your total cost, resulting in zero profit or loss, which I might point out is not the objective, but that is certainly what a break-even analysis helps us understand. And why do we do this? Well, we want to be able to evaluate how much are we going to need in additional volume in order to reach our goals of profitability. And this may have a very substantial impact on our strategy for pricing. In this day and age of a lot of inflation, I think we're still encountering small businesses that are very shy about increasing prices because they're afraid they're going to lose customers. But truth is that it may be that your costs are creeping up faster than your fears. And maybe you should raise those prices a little bit more frequently in order to stay ahead of the game. And certainly, the cost structure, as we said, especially with cost of goods sold and the other associated costs that it takes to produce the revenue that we want. So as a recap here for how we track financial performance, we want to use these tools. And if we are, how would I say, ready to plunge into a atmosphere of substantial growth, you want to ask yourself, to what degree am I sophisticated enough to be using all these tools? And if I'm not, then maybe I need to go out for some help for the personnel or the experience or other kinds of smarts that we need in order to power our organization. Because a small business owner, wearing as many hats as they have to, can't be expected maybe to put everything into place while they're also being a producer inside their business. Ideally, you want to get away from that environment where you have to be the producer. You want to start working on your business, as they say, not working in the business. So those are other lessons from other webinars that we've done, but worth emphasizing. So let's move into the final two elements that we said we'd talk about today. The first is the options for funding. And again, we've got numerous programs available at weteachsuccess.org that discuss some of these areas. I'm going to cite some of them here, but the time that we have available can't really go into great detail. We're just going to summarize that, well, maybe you need to add additional equity into the company in order to fuel this growth that you're hoping for. Maybe it's debt capital, because debt capital fundamentally is less expensive than bringing in a partner to whom you're going to pay a share of your profits forever and ever. Amen. So might be a line of credit, might be a term loan, but probably worth examining how to get debt financing and whether your ratios are right when it comes to the needs of a lender, whether a commercial bank or a community lender like CEDF. And there are some alternative sources out there, such as crowdfunding. I'm not going to say much about that, but there are some new things in the marketplace. I would caution you against any kind of funding sources that are in the wild west of the internet, because low documentation sources of funding can be very deadly to a small business, and they will eat up your profits, and they are best for you to stay away from. What I recommend is, again, going to our own educational website And Cliff Edico, who is an attorney in Fairfield, has done a number of webinars, I think probably for SCORE as well. And he's got these topics that are very relevant to our discussion here today. And you can just go on our site into the replay section, search Cliff's name, and you'll find the links to all of these programs. And finally, what are the resources available for guidance? Well, great one is SCORE. And Fairfield County has a bunch of volunteers, as Peter indicated, who are ready to roll up their sleeves and help you with the topics that we discussed today. There's also the Small Business Development Center run out of Yukon, and they have professional paid business advisors working across the state and a high degree of expertise. And the more sophisticated your business is, the more relevant some of their tools are going to be for you. They have a lot of software tools that are very useful for planning. And so you want to contact SBDC and see what they can do for you. CPA is not an organization, but I'm listing it because a lot of people just don't use their CPAs properly. And again, it should not be a drive-by relationship once a year to get your taxes done. You need to have enough of a relationship with the right kind of CPA practitioner who knows small businesses and is able to help you on the important things that you need, and someone who you're willing to trust as a close advisor, especially as you go into something as precarious as trying to grow your business significantly. And finally, we have the Women's Business Centers who do good jobs. Women's Business Development Council, which has offices across the state. And then the University of Hartford's Entrepreneurial Women's Business Center is another possibility. So with that, we'll take a look at any questions that we have. I'll see if there's something in the chat. Or Peter, did you care to moderate any of the questions? Or perhaps Barb will want to moderate questions if you've got any from folks that are at Known today.
So thank you very much, Fred. Let's, if you have if you are online, Fred.
There's no one here at Known but me, so no questions from this corner.
Well, we'll give a minute or two to see if anyone types anything in. Peter, you're breaking up a little bit. I'm not sure whose internet is a little shaky today, but if we have any questions, we'll be glad to respond. And if not, my contact information is on the screen too. So Dexter has a hand raised. Peter, I don't know how you're dealing with audio in your programs.
We don't have audio on this. So Dexter, could you put your question into the chat?
So while we wait for some things to be typed in there, Peter, you've got probably a team at SCORE that has a lot of financial experience. What do you find are common questions for individuals who are looking for help with growing their businesses?
I'm sorry, Fred, could you ask the question again?
Oh, sure. Yeah, I was just wondering from your interaction with your colleagues at SCORE, what common questions you find that people usually have when they're considering business expansion?
Well, the question that we probably get most often at SCORE is about getting access to funds, raising funds, finding sources of funds, and that's a business that you are in, Fred. So could you just, can you kind of remind us of the 1, 2, 3s that people have to have ready before they come looking for funds?
Okay, and we do have Dexter's question here, so I'll answer Peter's question here in a moment. Let me respond to Dexter. How do you start getting this information together? Well, yeah, it's a process. I wouldn't say that it's something that you expect you're going to have gathered by Monday morning if you're starting Friday afternoon. Again, I would just lay out all of the elements that I've got in the slide deck here, and ask yourself, what can I do to be responsive to these ideas in order to improve my ability to do better forecasting and have better management control of my process as we continue to go. So sorry, Dexter, kind of a vague answer to your question, but it tends to be so situational based on the business and the business's internal resources, your staffing, and your external resources of, who you have as advisors when you need to consider financial questions. So back to Peter's question here, while we wait any other Q&A. Peter, yeah, you're right. We're often, as a community lender, approached by a number of businesses that are maybe either considering initiating their operations, which I understand SCORE volunteers get a lot of contact from individuals that are considering going into business. And we do about 25% of our loans from pre-revenue or startup businesses. But what do you need? Well, you need a lot of things that are very similar to applying at a commercial bank. Commercial banks are highly regulated institutions for the protection of the investors, protection of the depositors, and all the other stakeholders. And so, they have pretty tough lines on credit score and time in business, profitability, and collateral. And as a nonprofit organization, we're able to be more flexible in many of those realms, although we have to do prudent lending, and we do have, many of the same functional requirements that that a bank will need, such as financial statements, such as tax returns, such as personal financial statements, maybe some other exhibits. But the fundamentals are that we can be more flexible than a bank oftentimes. And when it comes to credit score, we want to know what the big picture is. Sometimes a number itself doesn't tell the whole story. We've got a question here in the chat. I opened a business checking account and then hired someone to help me set up QuickBooks and be my financial thought partner for how to approach this work. I paid her for one-off meetings. When I had the money and incrementally built my financial system, now her team does my bookkeeping for, let's see if we can roll down and see that whole thought. Now her team does my bookkeeping for me, though I meet with them quarterly. Here, her team.
That wasn't a question, Fred. I was
Okay.
trying to respond to Dexter about how do you start? Because I started and I did the cardinal sin of not having a separate checking account.
Good scenario.
Right. And so when I opened it, I was like, okay, I'm going to start acting like I have an actual business here. And I didn't have the money to hire somebody to work with me every month. So when I had money, I would sign up for a 1-hour meeting with, it's Chantel Garcia, I believe you know who she is, of Innovative Consulting Solutions. And I had her piecemeal help me think through and build stuff. And then eventually I was able to hire her team to take care of the full picture. And they give me my monthly reports and all that stuff. So I did things incrementally because I was like, I don't know what I'm doing. And it was kind of painful. I wish I had started doing it right from the beginning, but I think no matter where you are, you can start. That was really the message.
Right. And I think the theme of this particular program was really trying to be responsive to businesses that are going concerns, that have been in operation a while, that have probably what I would call at least a basic plateau of success, and they're looking for substantial incremental growth. That was kind of the, I guess, the mission as explained to me by SCORE. And I think in some respects, that might be a little confusing, especially for businesses at a startup level, because if you're going from darn near nothing to something, that sounds like substantial growth. And in fact, well, maybe it is. In early stages, you might be doubling or tripling or multiplying your sales very quickly. But a lot of the tools that we are talking about here really are only applicable, kind of once you've been in business a good long time, and you've got some history, and you've got the ability to put some of the more sophisticated techniques into place. If you're simply, I guess, doing things incrementally, as you explained, Barb, that's not an unusual situation, especially for individuals that are taking things from maybe a side gig sort of environment to a full-time small business situation. And yeah, you've got to climb the ladder one rung at a time. So don't get discouraged if you think you can't put all of these tools into place just immediately. We, in fact, have to be realistic that at any stage of a business's growth, there are certain things that are going to be more relevant than others. And going back to the resources you have for advice, here's where meeting with your score advisor can be very useful. Someone who's kind of been around the block already can let you know that, well, it's okay that you're doing it this way right now, but maybe later on you want to aspire to getting this cleaned up and in a little better shape. How's that?
Very good. We have another question in the chat.
Yep.
Let's take this last question and then we'll wrap it up, Fred.
Okay, so we've got Megan asking, obviously balance sheets and P&Ls are easy to pull on QuickBooks. Well, I'll stop to say, yeah, they're easy. Are they credible? Easy to pull on QuickBooks, but for the other documentation, projections, cash flow, KPIs, etc., are there formats or templates to follow? Well, yeah, the internet is full of ideas on things to track. Again, it's kind of depends on your industry. If you can connect with, as an example, a SCORE volunteer who has some experience in the industry that you're in, you're going to find someone who knows exactly the sorts of ways to keep score of your ball game. And I would suggest that the one that you listed in terms of cash flow projections is a little more generic. Our website has a quick course on cash flow projections and kind of how to develop one. If you're going to go out for lending at some point, the lender is going to want them. But again, when we get to business plans and cash flow projections, I like to say, don't just do it for the lender, do it for yourself. Because you want to have that level of planning and competence and detail and thoughtfulness in order to be sure that you're going to have good results. And if you put that time into it, then the odds go in your favor much more readily.
Well, thank you very much, Fred. I'd like to thank Barb Nagel and Known Co-working in planning this workshop with SCORE. As a reminder, a recording of this webinar and the materials will be available within a couple of days on our website. Please check our website, fairfieldcounty.score.org, for information on upcoming webinars. Again, SCORE offers free individual counseling, so please use the link on the screen or visit our website and click Request a Mentor. We are available for sessions face-to-face, phone, email, or video. You will get an evaluation at the end of this webinar, and we take your feedback very seriously, so please take the time to fill out the evaluation. I'd like to thank all of you for attending SCORE's live workshop. And Fred, thank you very much for your time and expertise. We wish everybody a great afternoon. Thank you. Bye-bye.